Good evening. Welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. It was a zigzag day or a seesaw day on the markets, but towards close of trade, the global growth jitters which prevail over the commodity markets, which saw crude fall all the way to $47, had its toll on, or had its say on the Indian markets as well. We saw the Sensex and the Nifty losing 1/3%, and even the mid-caps as well. It's the advanced declines which give you that picture, more stocks declining than gaining. So in the end, not a very great day for the markets. Hi, Surabhi.
Hi, Lata. Yes, lots of earnings also coming in, but as Lata is saying, finally, the closing was on the negative side. Let's start with the headlines. Choppy day on Dalal Street with benchmark indices finally ending in the red. The Nifty loses 0.3%, dipping below the 8350 mark. The Sensex closes over 100 points lower. Bank stocks gain, but pharma, metal and IT stocks drag the market lower.
Punjab National Bank manages to arrest asset quality stress after 9 quarters of rising asset stress. The stock surges 5% as gross NPAs come just under 6.5%. Provisions fall 53%. Besides PNB, the mortgage major HDFC delivered a steady quarter with the net interest income rising almost 17%.
While moving on to other earnings, Maruti posts a 17% rise in revenues. Margins beat estimates, coming in at 16.3%. Profits surge 56%, but are still slightly shy of street estimates on the back of lower other income.
The mid-cap index fares worse than the frontline indices, falling almost 0.5%. Rising bad loans pulled down Syndicate Bank and Bank of India by between 6 and 9%. Dish TV falls 4% as revenues missed estimates. SpiceJet, Intellect Design Arena and Mahindra Holidays gain on the back of strong earnings. Well, that was an earnings-heavy day, as Surabhi told you. And these are the experts that we have lined up on the show for you. Samir Arora of Helios Capital and Jitendra Sriram of HSBC will join in with their take on both markets and earnings. We will also get you the managements of some of the public sector banks that declared their quarterly numbers today. And the global arena, Tai Hui of JP Morgan AMC joins in to tell us about how the jitters from China may impact global markets.
Okay, let's start first with the action on Dalal Street. 10 minutes in the red, then again 10 minutes in the green. That's how volatile markets were today. But trading was restricted to a narrow band on the benchmark indices, and eventually we ended up with marginal losses. Anuj Singhal is now here with a wrap of the day's action. Anuj, what did you make of it?
Yes, it was quite volatile, but it traded in such a narrow band that's not saying much in terms of what happened to the market. But suffice to say that the bias was negative. The market actually closed at low point of the day, and that despite the support that it got from the bank Nifty, the bank stocks did well today because of a couple of numbers, especially from the PSU basket that looked good. And that's why you saw the positive bit of move on the Bank Nifty, even though Bank Nifty itself was also quite volatile. Let's talk about the stocks then that led the market lower. The troika of stocks that really was responsible for the market ending lower today was this. HDFC down 2%, ICICI Bank, clearly a problem stock right now, down 2%, and Tata Motors as well, down about 2%. Some other losers in trade today included NMDC, down about close to 5% in trade. Hero MotoCorp, again a problem stock, down 3%. And Dr. Reddy saw some profit booking from lifetime highs, down 3%. There were some other losers as well. Asian Paints on profit booking. It's been a stellar run on Asian Paints this month. That stock was down 2%. Bharti Airtel for second day running, that stock was down. And Ambuja Cement, reacting to numbers, was down about 1.5%. There were some gainers. Of course, PSU banks were right on top. So PNB was probably your stock of the day, up about close to 5%. BHEL was up 2.5%. NTPC was up about 2%. Lots of movers and shakers in the mid-cap space. So let's talk about some of them. On the gaining side, we had Marksans Pharma, Manali Petro, NIIT. You could add SpiceJet and Jet Airways after SpiceJet's good numbers. So that's one pocket that did well. On the losing side, you had Syndicate Bank reacting to numbers, down about 9%. JP Associates was down 6.5%. And HDIL was down about 6%. Again, you could add a couple of names like Dish TV that didn't do too well. But overall, it was a bad day for the market, considering that we had such a big fall yesterday. So today was a bit of a follow-up day. 2 days left for expiry, and of course we'll also be talking about the FOMC meeting. So lots of cues lined up over the next couple of days.
Thanks a lot for that, Anuj. I want to pick up just one of the cues that Anuj spoke about, and that was the banking sector. The kind of numbers we got from Punjab National Bank and to some extent even Union Bank kind of liberated, gave a sense of relief to many of the public sector banks because both these banks indicated that the fresh quota of bad loans that they are throwing up is less than in the previous quarters, now for 3 quarters in a row. And that story was not repeated in Bank of India to the same extent. Bad loans were less, but otherwise, as a percentage of the total book, it was bad. In Syndicate Bank, it was bad. So the market now is beginning to separate the men from the boys even within the PSU basket. That is an important trend differentiator. If even half the number of PSU banks indicate a positivity or indicate that the bad news is over, then this market can get a re-rating because these stocks so much represent the economy that they would indicate that bad news is getting to be less and less. It can be very positive if more and more PSU banks show that. That's a longer term positive. Also, I want to point out that some of the mid-cap gainers kind of left you a little worried about the quality of this rally. I mean, we had stocks like Karuturi Global doing very well. And then even Marks & Pharma has run up a goodish bit and continues to remain in the green. Manali Petro, green today, red tomorrow, green today, red tomorrow. So the mid-cap shares still leave you a little bit of... leave you with a little bit of jitters. The Sensex and the Nifty may have corrected some of their excesses. You can't quite say that of the mid-cap space. So market still very much in dibbly-dobbly terrain with those with good earnings getting a relief, but those with bad earnings getting punished, and still a lot of fluff left in the market. All this can be treacherous, especially when you near the end of the contract, which is day after tomorrow, Thursday.
Absolutely. Perhaps we'll then look at more volatility. But for now, let's get you some expert opinions. Sameer Arora of Helios Capital says that fall in crude prices is a positive for India and that despite all the volatility, India remains an attractive market.
In general, an environment in which oil is down so much, gold is down so much, and also our relative attraction versus the world has been highlighted, not just on these accounts that we are commodity importers, but on ground that we don't interfere with markets, that there is no extra hype here other than maybe some internet unlisted stocks. It is a big positive in a relative sense, and the absolute negative only happens if you say that the rest of the world is going to be in super crisis. Many FIIs choose to also use P-notes because it's more convenient for leverage, for an immediate trade, because otherwise you have to pre-fund. The government itself has said that they will look at it more carefully. We know that there are clear bad pockets related to metals and materials because of global prices and maybe real estate because of some other things. And so we call it a long-short market. In general, pharma is very much stock-specific. So unlike in other sectors, you can say, okay, every metal stock, is in bad shape because not only there's global issues, but they're all mostly highly leveraged. In pharma, it is very stock-specific.
Well, the country's largest home loan lender, HDFC, managed to deliver a decent set of numbers in the first quarter of the fiscal. Ekta Batra, who was looking at the numbers closely, is here with us. Ekta.
Well, the NII this quarter for HDFC was in line with estimates. It was up 16.8% versus an estimated 16% growth. The profit was up 1.2% this quarter, but that was expected, and that's possibly what disappointed the street a little bit. But really, the consensus estimates was a growth of 4.5%. It came in at a growth of 1.2%. Now, the primary reason for the lower profit was because of lower dividend income on a year-on-year basis. That's because HDFC Bank gave HDFC dividend, which was now recorded in July and hence will show in the September quarter. So if you look at the dividend income which HDFC reported this quarter, it was 54.8 crores versus 302 crores on a year-on-year basis. In terms of the other parameters, it was a largely stable performance. For example, the non-performing loans were 0.69, which was absolutely flat year-on-year, and it was what they closed FY15 with as well. Net interest margins were at 3.8%, but they were at the lower end of the range, which was 3.8 to 4%, but flat on a year-on-year basis. Spreads at 2.31% versus 2.29% also was quite stable, and versus an FY15 spread of 2.32%. The loan book, however, was up only around 14% this quarter. Maybe the street was anticipating a higher loan growth from HDFC. On that note, let's listen in to the management.
Standalone basis, the profit after tax for the quarter ended June 30th stood at 1361 crores, 1,361 crores. It is important to note that the financial results of the quarter ended June cannot be compared with the corresponding quarter of the previous year. This year, the dividend income from the bank would be 315 crores. Hence, the two quarters are not comparable because last year in Q1 we got the bank dividend. This year in Q2 we will get the bank dividend.
Okay, that was HDFC. More earnings from the financial space. After 9 quarters, Punjab National Bank finally saw some bad loan relief. Gross NPAs for the bank were down by 1.2% and slippages are down by 62%. The management is also upbeat on the second quarter. But on the other parameters, the bank struggled in the first quarter with profits sliding nearly 49%. This is because provisions perked up by over 95%. Union Bank also saw some improvement in asset quality. Slippages down by 2.5% and gross NPAs down by 57 basis points. But no such luck for Bank of India. It saw gross NPAs rise by 141 basis points. In fact, asset quality has worsened by 353 basis points in the last 5 quarters. Similar story for Syndicate Bank. Gross NPAs jumped by 59 basis points and it now stands at 3.72% against 3.13% in the fourth quarter of the last fiscal. Let's now hear out some of those bank managements talking about the road ahead.
The restructuring book has come to an end. You will kindly note that during this quarter, the amount of restructured loans, the amount is just bare minimum 676 crores. And that too in just 22 accounts. In Q2 it is going to be even lesser because now forbearance is gone and no more accounts are there for restructuring. So this gross NPA will be, I want to bring it to as low as possible, but the number it will be too difficult for me to say, but it is going to be far better.
Going forward, I have a strong belief that this would be further decelerated. Even if you look at our numbers, which has slipped from restructured portfolio, it's benign 600 crores. The fact is our restructured portfolio is about 14,000 crores. The standard restructured portfolio is 14,000 crores. So whatever was done, it was done ideally. It's properly monitored through rank and file. So it's all about the monitoring. Our focus was more on smaller loan recovery. There was quite substantial some which could have come in, but there is a deadline for the balance sheet date. It couldn't come, so that benefit I'll have in the current, Q2.
All right, so those were bank managements who sounded confident that from the current quarter onwards, probably the scourge of bad loans will start declining. But now for the good news from the earnings space. Auto major Maruti Suzuki reported numbers for the first quarter. It witnessed very strong operational performance, which was in line with estimates. Sonia Shanoy is here to take us through the numbers. Sonia.
Well, it was a strong operational performance for Maruti yet again. The company reported margins at record highs, and in fact on the revenue front as well, it was a growth of 17% because of very strong volumes that the company reported to the tune of 13.8%. Domestic volumes were strong at 12.9%. Export volumes too surged by almost 22%. The margins for the company rose 420 basis points year on year at 16.3%, which was a record high, and the realizations for Maruti have improved year on year due to a stronger product mix, lower raw material costs and higher forex gains. However, the profits were below street estimates because of lower other income and higher taxes. The profits grew 56% but below street estimates as the other income fell about close to 30% and the tax expenses doubled. The tax rate stood at 28% versus 25%. All in all, good performance. The earnings does justify the valuation premium on the stock.
All right, Sonia, thank you so much for that. Let's move on now, get you some more views on the market. Jitendra Sriram, Managing Director and Head of Research at HSBC India, expects Maruti's share price to touch 6,400 in 2 years. On the Sensex, he continues to maintain an end-of-the-year target of 26,900.
We are seeing a lot of interesting product launches starting to come through in hitherto nascent segments for Maruti, which is like the SUV space, the multi-utility vehicles segments. The fact that it is upgrading its product slate, and in case that bull market is premised that if their models are indeed successful in these niches, then it could actually mean a lot more for Maruti, both in terms of top line market share and in terms of also the premiumization of the product slate. I would definitely expect that this big growth engine for the world, which has been China thus far, might cause some kind of growth scares as well. I think it's a very real possibility that you could see markets drift down a little from here. Our year-end target, as I mentioned earlier as well, is close to about 26,900 for the year-end. So it implies an absolute downside from these levels right now.
All right, on that note, we'll take a quick break, but coming up, we'll tell you about the government's divestment plans for IOC and also talk about some of the other companies that declared numbers today.